Hello, everyone. I'm Ken Hauk, Acting President of the Dartmouth Alumni Association of Silicon Valley. Welcome to the fourth session in our Sustainability Innovation Series. We're excited to have all of you joining today's session, and we invite you to visit our website, daasv.org, to learn about upcoming events and sign up for membership if you're not one already. Thanks very much. I'll hand you over to Kate Sackman Roski next, and she'll introduce today's presentation.
Thank you, Ken. I'm really excited to have all of you here. As Ken said, this is our fourth conversation in our Sustainability Innovation Series, in which we talk with people and companies innovating to protect the health of the planet. I'm Kate Roski, Dartmouth Class of '82, and your host for today's event. I'm delighted to bring you a conversation with fellow alum, Dr. Jennifer Jenkins, Chief Sustainability Officer at Rubicon Carbon. Rubicon Carbon is a company that has harnessed the carbon trading markets to enable corporations to both fund global carbon reduction while also meeting their corporate sustainability goals. This is a timely conversation because Rubicon Carbon was launched only 6 months ago and is already making an impact. Our format today includes a short introduction presentation by Dr. Jenkins, followed by a discussion about how the carbon markets work and the ingenious system Rubicon Carbon has developed. Dr. Jenkins is broadly responsible for ensuring that Rubicon's products and portfolio meet the highest standards for quality and integrity. She also leads the company's work on monitoring, reporting, and verification, as well as stakeholder engagement, ESG strategy, and thought leadership. With a technical background in carbon cycling and ecosystem science, Dr. Jenkins brings more than 25 years of experience on matters at the intersection of business and climate. She's a co-recipient of the 2007 Nobel Peace Prize, along with Al Gore and other IPCC scientists. That's the Intergovernmental Panel on Climate Change, and previously served as Chief Sustainability Officer for both NCX and Enviva. Not only did Dr. Jenkins graduate from Dartmouth with a BA in biology and environmental studies, she has several other notable degrees. She earned her PhD in ecosystem science and natural resources from the University of New Hampshire, a Master of Forest Science from Yale University's School of Forestry and Environmental Studies, and an MBA from University of Maryland's R.H. Smith School of Business. We're truly, truly delighted to have Dr. Jenkins here with us. I give you the fascinating Jennifer Jenkins.
Thanks, Kate. Yeah, thank you so much. It's really an honor and a pleasure to be here today. And I love, of course, talking with my fellow Dartmouth aficionados and supporters. So I'm honored to be featured in this Sustainability Innovation Series. Kate, I've really enjoyed the conversations we've had so far and looking forward to the conversation we'll have later on in the session. I'll talk more about Rubicon toward the end of the session, but really to give you a quick preview, Rubicon Carbon is a recently launched company in the decarbonization space, and we're focused on market-based products and solutions really aimed primarily at enterprise customers, with an initial emphasis on helping to scale the voluntary carbon market. So what I'm going to do is talk a little bit about the voluntary carbon market, VCM for short, talk about how it can help society in its net zero journey, and then we'll move into the conversation about Rubicon, and we'll probably go back and forth between those two things when we have the conversation with Kate and the Q&A with Kevin. Typically, we start these conversations with a pretty depressing image of like the Keeling curve that shows global atmospheric CO2 concentration, showing the rapid human-induced increases in atmospheric CO2. And then we follow that by like some really apocalyptic images of climate disasters like rising sea levels and hurricanes and droughts that takes up some time. Instead of doing that, I'm going to go ahead and assume that this audience already understands the nature and the extent of the climate crisis, and that we're all sort of on board with the urgency of solving it, right? If we're agreed on that, then we can go ahead and have a discussion about what the solutions are. This slide I'm showing you here comes from information presented in the UN emissions gap report in October 22, but the urgency of action was really just underlined a couple of weeks ago, again, by the IPCC in the synthesis report from the 6th assessment report on climate change. I just want to, I put some images from the sort of press briefing that the IPCC did about that assessment report up here, because I was just so struck by the starkness of and the really definitive nature of what these scientists are telling us, right? I've been in rooms with the IPCC, I've been there. Basically, what it is a group of scientists from all around the world, and they literally agree word by word on every single thing that is in the summary for policymakers in those reports. So the fact that this group of scientists, and if you know scientists, they hardly ever give you a definitive answer on anything, right? It's always, calculated risk. But here they're really saying the pace and scale of climate action are currently insufficient to tackle climate change, right? So we should just sit on that for a second. It's hard to get them to say much. The fact that they came out with this statement, I think, should be alarming for us all. It should really, increase the urgency of our action, make us all a little more passionate about solving this problem. So the graph from the UN emissions gap report, they lay out, in order for us to reach 1.5 degrees of centigrade of warming as a globe, they say here are the emissions trajectories that we will need, right? And so that's the bottom line here, the 1.5 degrees C range, the little green sort of wedge at the bottom. And then they say, okay, let's just say we wanted to get to 1.8. What would that look like? And it's a little different. What if we needed to get to 2 degrees Celsius, right? And remember that 2 degrees Celsius is the level at which scientists are saying, okay, that's like, we could probably we're kind of not really sure what that looks like as a planet. It could be pretty, it's sort of, it gets into the realm of we're not really sure what that's going to be. And we're a little worried about it. So that's what 2 degrees looks like. And then what this graph does is it says, let's look at what the current policies are and what they would get us, right? So that's what this blue line, current policy scenario there in 2030. So let's be clear, those are the current policies that the countries have agreed to in their, sort of Paris Agreement or in their other sort of policy commitments, right? That's what's baked in today. The NDCs are called nationally determined commitments, and that's what countries have agreed to coming out of the Paris Agreement. And there's 2 kinds of NDCs. Some of them are conditional, that are like, I'll do this if you do that. And some of them are unconditional, which are like, yeah, okay, we can commit to these things regardless of what anyone else does. So the unconditional scenarios are going to get us to somewhere above 2 degrees. The conditional scenarios are going to get us to like a little bit below that, but still above 2 degrees. What we need to do, though, is IPCC told us this again last week, we need to cut emissions in half by 2030 as a globe. Okay, so we're 2023, we've got 7 years to do that. And that gets us to 2050 net zero, right? And remember that net zero is a place when any emission is balanced by a removal. That's what that means. So there's no net new greenhouse gas added to the atmosphere. So the message I'm trying to send here is, yeah, more ambition is needed. Okay, what do we need? We need systems, we need incentives. We really need to do all of the things, right? I think over the last couple of weeks since the IPCC report came out, the Oscars happened, we're saying we need to do everything, everywhere, all at once. Right. And it's going to be complicated because there are a lot of places where emissions happen. There's a lot of really sneaky processes that you don't think about. They're kind of baked into our current ways of doing things. Policies, incentives need to change in order to cause and incentivize that transformation. It's going to be expensive. As some estimates are, we're going to need $3.5 trillion in addition to what's already being spent to reach the net zero transition. And that is actually 3.5 trillion every year between now and 2050. In order to get us there. So where are we going to get that money? Probably not from public funding, not from governments, probably not really from philanthropies. So it's probably going to have to come from the private sector. That's where the carbon market comes in. How can we mobilize? And one way is for companies to participate in the voluntary carbon market. The voluntary carbon market is a system that already exists, okay? And that's why it's so perfect to help us solve this problem. It's not a new institution that needs to be created. It's one that we can build on and use that people already understand and accept. So the first projects in the VCM were established in 1988. It was built as a mechanism for moving capital from the private sector to the places where it's most needed. And it's typically in the VCM, projects are sort of created and developed at what's called the project level. There's different kinds of projects that people can invest in different sectors and that sort of meet different needs. Examples are a nature-based project where you might avoid deforestation in a country that's vulnerable to forest loss. An industrial example might be switching a manufacturing process from a high emitting to a more low emitting chemical, or reclaiming HFC, which is a chemical that's used in air conditioning that has a very high global warming potential. When it's not feasible for an entity to make the change without some additional cash, that is where a carbon credit revenue can come in. And the market is driven today by corporate players who are seeking to make their sort of net zero change, right, to meet the moment. And these companies are interested in, driven, primarily by stakeholder concern, shareholder attention, to respond to their stakeholders by creating and meeting science-based targets that will, when all those science-based targets from all the companies are put together, will help society broadly to meet its net zero goals. And so the demand on that basis is projected to be pretty big, right? A lot of companies meeting a lot of goals are going to need a lot of credits, okay? And so the volume issued in 2021 was about 500 million tons. In 22, it actually went down slightly, but projected volume is expected to grow by about 25 times by 2050, and even more in terms of dollars. So just a quick sort of intro to the nuts and bolts of a credit and how a credit is developed and delivered. So the ecosystem of credits involved a series of players, right? And each player has a different role in the process of bringing a credit to market. The first step is a developer who conceives of a project they might want to develop. And like I said, it could be anything, as long as it meets the quality tests. And we can talk a little bit about that later. The key really, though, is that the money from the credits is what caused that project to happen. That's sort of the threshold requirement. In order to bring a credit to market, they have to have a methodology that's approved and vetted that ensures that people know what it is, what it's accomplishing, that lays out the details of how that credit is generated. The credits are then issued by a standards body, which is sort of an entity that holds and manages the evolution of a standard and the improvement of that standard so that quality can be determined. And then once the project's been carried out, the credits have been issued, they're typically held on what's called a registry, which sort of keeps a record of what the credits are, who's retired them, who owns them, and what the status is. Multiple bodies are involved in ensuring quality. Like I said, there's a lot of sort of groups and entities that are involved in this. Most recently, last week, the Integrity Council for the Voluntary Carbon Market issued what it's calling the Core Carbon Principles. Now, those were out for comment in 22. They were just finalized and made public last week. They're an effort to create standards that everyone can agree on that ensure what makes a quality credit. And so the key concepts around quality in the market are these 6 things, right? In addition to the governance principles that were recently articulated by the ICVCM. Really, additionality means that's what I was talking about before. That's the threshold, right? This project would not have taken place if it were not for the carbon credit revenue. In other words, the project is additional to what would have happened without the revenue. Permanence means the impact of the project is permanent, and typically 100 years is the standard that we use for permanence, although that is evolving. Leakage means that you're not just sort of pushing the emissions somewhere else, right? In other words, if I reduce my emissions here, it does in this jurisdiction, somebody the next state over isn't just going to increase their emissions, to compensate, right? That has to be true. Otherwise, we haven't really solved the problem globally. Co-benefits refer to other kinds of things that can be achieved by the carbon market. For example, avoided deforestation project, you might also be helping communities to find other ways to develop revenue, right? If it's a typically forest dependent community, or maybe there are needs in the community that the carbon credit revenue can also meet. And another example of a co-benefit is a project that saves or improves or protects biodiversity in some way, right? So those are co-benefits. It's important that credits not be double counted, right? We want to make sure that if I use a credit and count it against my emissions, that I'm not then just sort of selling it down the road and somebody else uses the same credit to meet their emissions. And then they have to be accounted for accurately. There are a couple different kinds of credits, right? I mean, how can they be used along the path to net zero? This slide is intended to show us that early on in the trajectory of using credits, imagine this is sort of one company's or one entity's emissions, the trajectory. So over time, there's avoided emissions that need to happen. An avoided emission is basically this emission was happening and we're reducing that emission we're sort of avoiding an emission that would have otherwise happened, right? That's the definition of an avoided emission. A removal is where we have carbon that's sort of just hanging out in the atmosphere and we actually remove it and store it somewhere else, right? A great example of this is if you're trying to drive your car in reverse, it's going at a certain speed. If you want to put it in reverse, the first thing you got to do is slow that car down. Think of that as the avoided emissions. We need to slow down the process of adding carbon to the atmosphere. Then when we get to zero, okay, that's great. Then we need to actually remove carbon from the atmosphere in order to sort of reverse the damage, if you will, that's already been done. Now we get into the kind of the juicy stuff, right? Like the current events and sort of what's happening in the market today. The market has slowed a little bit over the last year. And in the press, we're seeing a lot of headlines about questionable impact in certain kinds of carbon projects. And this is a small market. It's opaque. It's hard to transact. There are 4 different registries. They have different methodologies and oversight is inconsistent. And customers are concerned, right? When they hear about impact, maybe not actually resulting in 1 ton per credit issued. What we're finding at Rubicon, customers need to get their confidence back. And one thing that's really going to be critical to that is to minimize headline risk, right? Nobody wants to be on the front page of the newspaper for having invested in a project that was later sort of exposed as being somewhat risky. The problem is when people don't invest, that hinders the flow of capital to projects and it delays the growth of the market. And the market overall is, we should acknowledge there are risks, there are issues with some of the credits that, we know a lot more now, right, than we did in 1988 when these first projects were developed. We have methods that are better. We are developing better methodologies all the time. We're moving toward jurisdictional approaches, for example, and some of the main registries that are developing projects are getting better at that and improving their methods to mitigate the risk of things like over-crediting. These are the kinds of things that we're trying to solve. And this is where sort of Rubicon enters the picture. What we have is a portfolio of credits. Okay, so we are creating and curating portfolios of diversified projects that are intended to minimize the project level risk for companies. A company can, when they invest in a Rubicon Carbon ton, they're basically getting a share of a diversified curated basket. So we actively manage that basket to ensure that through time, the projects in that basket are the highest quality available in the market. And the way we ensure that is we engage in a 2-step screening process. The first step is ensuring that with using our guardrails, that the credit types we're investing in are the ones that have the highest likelihood of impact. They're measurable, they're permanent, right? So these are the ones that really sort of meet the criteria to the highest degree possible. And then our second level of curation is really in 2 parts. We're assessing the individual projects within those credit types that we believe are the best. But we're also building an MRV or monitoring, reporting, and verification system that will allow us to, ongoing basis, assess the quality and the deliverability of the climate impact. We're also looking at ways to manage over-crediting risk, which is a key issue in the REDD+ market, particularly. REDD+ is reducing emissions from deforestation and degradation. So that's the avoided deforestation projects I was talking about. Over-crediting is sort of a known issue in that category. And so we're looking at how can we mitigate that risk? Because the fact is while we are working on improved methodologies at the jurisdictional scale and the improved sort of methodologies from the standards bodies, we do have a legacy of projects that were developed, early, sometimes in, 2000 and 2005, that are issuing credits every year between now and say, 2030 or 2035. Those projects, they're doing good work, right? And there are things that we can do, we believe, to mitigate the risk and turn them into great quality projects. So the end result is Rubicon Carbon and our overall value proposition, which is something Kate had asked me to make sure I emphasize. We are actively managing our portfolios, so we have diversification. We can undertake, terrific and intentional quality assurance. and work together with companies to help them to meet their net zero goals through investment in the voluntary carbon market and scaling that market through our own investments in high quality projects.
Thank you, Jen. That was a fantastic overview. And I think it opens up the door to some really good discussion. One of the things that comes directly out of what you just finished saying is you've got this portfolio. How many projects do you have at one time, and how do you manage the oversight of all these projects as your portfolio grows and grows and grows? You'll have to have a lot of staff or partners potentially to oversee that.
So yeah, so we are essentially a decarbonization business, right? That's our value proposition. We're starting with these two baskets, these two flavors of Rubicon carbon tons. And so the first flavor is we have a nature-based basket, and that nature-based basket is made up of our focus early on, right? Is the spot market, right? So that is credits that are available to retire today. So, we didn't want to have customers come to us, now and say, I'm ready to buy my credits. And we would say, okay, great. Thanks. Come to us in, 2025 when we've got some credits, built and ready to go. No, it was important to have them right now. So we bought credits on the spot market. We bought 20 million tons worth of credits. If you guys know this market, that's a huge portfolio to have in this very small market today. And so our nature-based basket is 10 RED Plus projects. So they're all avoided emissions. They're diversified in that they're from different geographies, but they are all in the RED Plus category. And so that's the RED Plus basket. The second basket is the industrial emissions reductions basket. And so they're not as, like sexy as the nature-based projects. They're sort of really very much more bread and butter, landfill gas destruction, HFC reclamation, chemical manufacturing agent substitution of a high GWP for a low GWP gas. That's the industrial basket. There's a few more projects in that basket because each one's a little smaller, maybe 25 projects in that basket. But our portfolio is actually bigger than that, right? Our portfolio is at 20 million tons. And in our baskets, because we have the opportunity and the ability to swap projects in and out, we don't keep our entire book in the baskets at any one time.
So it sounds like you feel confident that these are quality projects that have been pre-approved by others.
They definitely are. I mean, we have one of the screens that we use, and this is an interesting way the market is evolving. One of the screens that we used early on was that each one of the projects, the requirement was that it had to be listed on one of the major registries. Okay. And so what that means is the methodology is formally approved. The project developer has applied an approved methodology. It has been vetted by a third party per that standards body's requirements, and then listed on the registries transparently. So the registries are intended to provide, one level of surety around quality, right? And so, yes, all of our credits are listed on registries, which gives them sort of a baseline level of quality. Now, in addition to that, we're also aware that just being listed on a registry in today's market isn't necessarily enough to define quality, right? A lot of the credits that are being accused of having overcrediting risk, they're also on registries, right? So we found it was important for us to undertake our own and build our own monitoring and reporting and verification system, which is what we are doing now, right? So to build that portfolio, we relied on a whole nother body and a whole nother group in the ecosystem of ratings agencies, which as another sort of companies that have cropped up in the last couple of years to provide feedback and insight to buyers on quality and sort of the characteristics of credits and projects.
So these are carbon rating agencies. Is that what you're saying?
Yes. Yeah. There's carbon credit ratings agencies out there whose job, they're like Moody's, right? But for carbon credit.
But for carbon. Okay, cool. So backing up a little bit, when you talk about RED Plus, I assume that you're talking about projects that are specifically for RED listed endangered plants.
So no, actually, RED doesn't mean RED listed. It's not UN RED. What it means is it's a shorthand, it's an abbreviation for reduced emissions from deforestation and degradation, REDD.
Got it.
And red plus means that it's got other co-benefits, like there might be a biodiversity angle or, a human sort of SDG type angle. So that red plus category is a category of credits. And probably I would say 2/3 of the credits that are spot credits in the market today are either renewable energy or red plus.
So another related thing about that you were just talking about is you mentioned the idea of retiring credits. Can you explain what it means to retire a credit?
Remember I said developers sort of create projects and they get those projects listed, right? They create projects typically following an approved methodology, right? And I want to talk about how that's changing too, actually, because that's really interesting. The way it's worked up to now, right, is that developers create projects following an approved methodology that's published by a standard. And then the standards requirements are that developer, once it's gone through the process of working on its credits and putting together its project, it has to get those credits and that project validated and verified by a separate approved body, like an auditing firm, right, called a validation and verification body, or a VVB. There's so many acronyms in this space. Okay, and so the VVB then says, yes, you followed the rules. You meet the requirements to issue these credits. And once that happens, the credits can be issued on a registry and they're still live, right? They can still be transacted at that point, right? And they can still be transacted up until the time somebody wants to use them and count them against their emissions ledger. Another option is to retire credits without counting them against a ledger. And that's great because then the credits just go away and somebody, did a good thing. And there were no emissions were, used in the saving of this carbon, which is great. So the process of retirement, a company A says, I've got, 100 emissions on my ledger. I can only reduce, right? I'm working really hard and I can only reduce like 80 of them through my own sort of scope 1 and scope 2 initiatives. There's 20 that I just can't squeeze out of that system right now because I'm connected to a grid that's dirty or something, right? And I just can't, there's no way for me to really fix that. So I have then this, and I want to get to zero. So I have these 20 credits that I need to erase, right? Or take off my ledger so I can buy 20 credits. And then in the year that I want to erase those credits from my ledger, that's the year when I retire my credits. And when you retire them, the registry basically ticks a box and says, okay, these credits have been retired. And they will typically want to know who retired them. And so the company that retired those credits will be listed on the registry most often, although that's also changing, and then everybody knows transparently that company or company A retired 20 credits from this registry's ledger.
What if the reverse is true? They want to retire 20, but they buy 100. What do they do with the other 80? They can sell them?
Yeah, they can do whatever they want with them. They could retire them and not use them against any emissions, which is cool. They could just keep them, right? Because everybody thinks the price is going up. So that's probably a good bet. If you believe the price for carbon is going to go up, you should buy it and hold it, right? A lot of companies might now say, gosh, I think I can see the sort of writing on the wall with my emissions trajectory. Now that I've gone through my inventory process, I have this many scope 1 emissions. I think it's going to go up by this much as I grow or, as my footprint expands. So I should probably buy enough carbon credits now so that I can just retire them, year over year sequentially, a few at a time so that, I can meet my goals in those subsequent years.
So you've talked about the developers of projects. Could you give an example, no names necessary, but sort of a really concrete example of a development?
So the most tip, and I'll just, because we're talking about Red Plus, I'll just use that as an example. The most sort of obvious and concrete, probably well-known example is, a community in a tropical nation where a lot of deforestation is happening, and that the deforestation is happening because pick your economic motivator, right? Like a lot of times deforestation happens because people want to clear the land to use for agriculture because agriculture is
palm oil.
Yeah. So, okay. So let's say you want to clear the land for agriculture. Okay. Agriculture more lucrative. So a developer might come to that area and talk to the people and say, look, is there another option for you guys, right? Could we create another source of income for you that would compensate you for the loss of potential from losing this forest to agriculture? Is there another way we can do this, right? And they would work with the community and they would try to develop sort of a carrot style approach. Like, if we gave you this much money, would that compensate you, right? Sort of how would that work? And then the developer will, and that's, that interaction with the community is complicated and difficult and requires a lot of boots on the ground. Okay, so let's just sort of assume that that's happening and that that's going to be successful. I'll talk a little bit then about the technical process. So, they will present in their project, they will say, I think I can reduce deforestation by 10% in this particular geography, and they'll draw a boundary around where the geography is. And that boundary is called the project area. And so that's the area on which they're going to be evaluated. So they can easily measure deforestation over time for the next 30 years in that geography, right? And they're going to do that. The real tricky part comes in when they say, what would it have been if we didn't have this project, right? That's the tricky part. And so to do that, what they do is they create what's called a reference area. And that reference area is supposed to be similar in all ways to the project area, but they get to pick it, right? And so the reference area it ought to be similar in terms of how close it is to other forms of development. It ought to have a similar forest type. It ought to have a similar levels of demographic use, right? It ought to have similar population density. It ought to be similar in as many ways as they can make it to the project area, so that they will then compare over time the deforestation in the project area with the deforestation in the reference area. And then the difference is the improved deforestation that they then get to credit. Does that make sense?
Yeah, I mean, in an ideal world, all that land is being preserved through carbon credits, but that's
ideally the reference area would also be preserved, right? But that's not right. That's not happening. So one of the really interesting sort of developments and improvements, I mean, you can see how that could be gained, right? That's, people do the best they can, and the methodologies allow, right? I mean, the proof methodologies do allow for, they allow for some wiggle room in how these are defined, and they have to. It's going to be otherwise really hard, especially when you think about how this whole system was invented in sort of the 1990, before we had easy access to like free Landsat data and all of the other kinds of, tools that we have today. So one of the things that's happening now in the market, and, I think this is a super improvement, is the establishment of jurisdictional REDD+, right? Which is where, I think the rules are still being sort of ironed out, but it's essentially the baselines are established at a jurisdictional level or at a country level, right? And they're sort of negotiated and agreed. So you don't get to play with the baseline as a project developer, right? Now, you can still, and this is, the problem with this is that this is exactly the sort of issue that was pulled out in the Climate Action Reserve in California a few years ago, right? Like it's even though the baseline is set and at a jurisdictional level, doesn't mean that people aren't going to try to choose where they do their project depending on the baseline in order to sort of maximize their project, effect. That will still likely be, there's still some, there's nothing is airtight, but this is, I think, a giant step forward in terms of sort of shoring up and really making sure that these methodologies are doing what they're intended to do, which is reduce deforestation.
So the Paris Agreement and the COP meetings all bring out the fact that the global north has been emitting carbon for a century or more, and the global south still needs to develop. Is the mechanism that Rubicon Carbon created potentially a way of funding the global south through corporate money, because governments are unlikely to be able to spend the money that, or be willing to spend the money that's necessary to do that?
Yeah, I mean, $3.5 trillion, that's globally, right? That's a lot of money. And I think if you look at a graph, and I think we did this early on, if you look at a graph of sort of which countries are sort of on track to meet their Paris Agreement targets and which ones are kind of not really on track, maybe falling a little short, the countries that are more developed are the ones that are more on track, right? And the countries that are less developed are the countries that are not on track. And
we have the money to spend.
yeah, I mean, it's going to be hard. And I think if they are also trying to accomplish this gigantic, let's be honest, it's a very aggressive transition, while they're also suffering the impacts of more and more drought and more, agricultural loss, I think it's going to be increasingly hard. And they're trying to recover from the last storm, right? I mean, I think it's going to be increasingly difficult for vulnerable countries to really provide their own capital. Most of the credits that are issued today are already sort of issued in the developing world, if we're honest. There are very few projects. I mean, there's some like improved forest management projects that are in the US, but the forests that need protection are the ones in the global South primarily. Similarly with some of the sort of renewable energy transition needs, that are highly dependent on coal, places like Vietnam, Indonesia, South Africa, right, where funding and capital is badly needed to undertake the transition. So yeah, I think we should view this as a productive way to sort of step in where government impact has been less than effective.
So one last question before we open it up for Q&A. So in a country where like Vietnam that is going to need more energy in order to develop their economy, would a project like installing a solar farm be something that would be in your portfolio?
Yeah, I mean, I think remember the quality parameters have to first be met, right? And so the first thing you have to know, there are tests around things like additionality that projects need to meet in order to be eligible, right, for sort of crediting. And one of the criticisms of renewable energy projects, which are, making up a big portion of the market today, one of the criticisms of renewable energy projects in OECD or developed countries has been that the cost of installing solar and other renewables is actually now almost less than the cost of installing new coal, right? And so it would be hard to justify a carbon credit project in the US, for example, that relied on installing renewable energy because it's just not additional. It was going to happen anyway because the cost is already less. So that may not be true, right? Depending on the financial conditions and the economic sort of status and the prevailing, winds in the country, in whatever country you're talking about. So it really has to be sort of a very regional analysis for additionality. But yeah, to your point, yeah, absolutely, right? In places where that's needed, this can be an effective tool.
Wonderful. Okay, let me turn it over now to Kevin Jiang to pose the Q&A questions that have come through in the chat and in the Q&A.
Thank you, Kate. Thank you, Jan. Yeah, we have quite a few questions here. Start with a question from Scott Gardner. Please discuss the preference of the buyers for avoidance reduction credits versus removal credits. Are both still valued equally? And can you please advise the per dollar per ton range?
Yeah, so a couple things are interesting in this market right now. I think, the avoided emissions versus removals. It used to be that, you could just sort of buy a ton and it was a ton and you didn't have to worry about whether it was an avoided emission or whether it was a removal or what it was. Then, a few years ago, like Microsoft burst on the scene and they started talking about how they were only buying removals. And now what we see is in the market, a lot of our customers do have a preference for removals. Unfortunately, removals aren't available, right? Removals are probably 2 or 3% of what's in the market today. So that's one issue. And then the second issue is removals really are intended, and the science is telling us this, and IPCC, has also spoken out on this. Removals are really intended as a way to sort of squeeze out the very last of the emissions from the system, right? They're not we can't rely on removals alone to meet our net zero targets. There simply aren't enough of them, and they're much too expensive. And we need to do the hard work of saving the forest and mitigating our scope 1 emissions in the value chain, of converting from natural gas over to, other maybe renewable natural gas or other forms of energy. And to your question on price is all over the place, right? Even with avoided emissions projects. And this is another thing that's interesting in the market, is that it used to be a ton was a ton, right? And it would have, have one price. You don't do that anymore, right? Now there's definitely quality distinctions in the market. There's co-benefits distinctions. Projects with co-benefits will earn a higher price typically. Removals typically earn a slightly higher price. And the kind of removals, right? So nature-based removals are not as expensive as like a tech-based removal. So for example, direct air capture from, just from the air, there's a, company called Climeworks that's building sort of these giant, removal machines. Those removals are expensive. They're, pushing $500, $1,000 a ton, right? Where a typical nature-based project might be $10 or $15 a ton. And it's, so there's a wide variety in price.
Thank you. Next question from Rowan Whalen. What is the difference between Rubicon and the other offset /CDR/REC market out there today?
Thank you for this question. I love this one. So you can just go out to a broker and ask them for a project, and you can buy a project, right? Totally. And they're probably offering, you can probably get the same project from them that we're selling, honestly. But the difference is we are packaging those projects into a curated portfolio, and we're assessing quality on the front end so that you don't have to, right? So this is a solution that's really intended for, it's probably not for Microsoft, if we're honest, right? Because Microsoft has reams of people on their team whose job is to vet projects like this. Some of them are even, I think Bloomberg had a piece just last week, a lot of companies are actually now investing in their own projects, right? And they're sort of going out and working directly with developers to bring projects to market. So, this solution is really for the company that doesn't necessarily have or want to build a giant sustainability team, but wants to know that they're protected from the sort of delivery and headline risk associated with projects that might not be the best quality. So a couple of things are happening. You're not investing in just one project. So you're not sort of putting all your eggs in that one project basket. It's a diversified portfolio. So you're sort of diversifying the risk in that way. We're also actively managing it for you so that when new information comes to light, either from our own internal monitoring process or from an outside source like a ratings agency or a journalist, we can evaluate the information that's there and decide how to change the risk buffer, how to manage that project, whether we still want to have it in our portfolio or whether it's appropriate at this point to take it out because we believe it has limited impact. The other thing we're doing is, I think I alluded to, sort of this method for assessing and compensating for the risk of overcrediting in a particular project, right? That's something we are doing for our customers that is, is sort of different and I think separates us from the rest of the market. So in short, yeah, we're not just a broker, right? We're offering a package portfolio with risk adjusted and active management and diversification.
Well said. Thank you. Next question is kind of interesting from a Korean Neil. SBTi has some guidance that carbon credits should not be counted against net zero goals to encourage companies to focus on reducing emission first. That's like avoiding and in contrast. What is your take on this?
Yeah, so thank you for this question too. This is a major focus for us. So SBTi is, for those who don't know, it's the Science Based Targets Initiative, and it's a consortium of NGOs that are providing guidance to companies as they seek to set and achieve their net zero goals. And in its net zero standard, which was released in 2021, The SBTI talked about what it calls beyond value chain mitigation. And beyond value chain mitigation is basically if you want to invest in a carbon credit, or if you want to mitigate emissions beyond your own value chain, how can that happen? And they issued guidance that they would say, and Corinne, I agree with you, but they would say that the guidance is being misinterpreted, right? Because they say, well, we don't hate offsets. We actually want the market to grow. We like the offset market. We understand how important it is for society to meet its net zero goals, and as a sort of a conduit for funding that might not otherwise be available to vulnerable communities. But what they really want to accomplish is to make sure that companies aren't let off the hook, right? So they really want to make sure that companies follow what they call a mitigation hierarchy, which means they reduce emissions in their own value chain first. We 100% agree with that, right? And all of the companies that we work with, they have done the work, right? They have done their inventories. They are trying to reduce their emissions. This is a commonly misunderstood, right? But well known in the market. These are the companies that care and that are willing to invest. SBTI is releasing. They are releasing guidance. They have stated publicly that they plan to release additional guidance in 2023 that will clarify their stance on how companies might use offsets in their net zero trajectory, right, in their net zero journey. But in the meantime, their advice has widely been viewed as not allowing offsets and actually essentially telling companies that they don't have to invest in offsets, right, until right before their net zero target date. And that is chilling the market, right? That is definitely causing people not to invest. It's also, the problem is when everybody, comes ready and says, they raise their hand in 2030 and they say, we're ready for our offsets now, right? If we haven't invested in them along the way, they're not going to be there, right? And the market is not going to mature in the way that we needed to in order to meet those targets at the time. SBTI has said that they plan to update this guidance and sort of make it more clear that they don't hate offsets and that they do want the market to grow. Who knows, right? It's not clear. I think ultimately, there are other entities that will, this is frustrating to everyone, right? Because I think it's basically letting companies off the hook, right? Yeah. If they say, well, SBTI doesn't like offsets, great. So I can just sit around, I don't have to do anything then. That's perfect. And it's, I think it's having the opposite effect, frankly, from what it was intended to, in my view. So that's something we're working on.
Thank you. The next question is from Jan. What are the top 3 trends in the voluntary carbon market that excites or worry you the most?
The top 3 things?
Yes.
Okay. You guys, there is so much innovation happening right now in the voluntary carbon market. It's really stunning and it's amazing. I have talked to probably 40 or 50 different developers who are developing different kinds of projects that are going to help companies and individuals and entities achieve emissions reductions in so many different ways, right? Everything from reduced emissions concrete to retiring oil fields early, regenerative agriculture and storing carbon in soil, to improving forest management and extending rotation length, to there's so many interesting and very cool things people are doing in this space. I find that really exciting. That's one thing. The second thing I'm excited about is sort of the evolving role of the registries and the evolving sort of nature of how standards are being set. I think the existing registries have served a great purpose. We've built a fantastic foundation on them. I think it's going to be hard for them to keep up, right? These are NGOs, they're understaffed, they're overworked. They're really, really trying hard to keep up with the demand. But I think what's going to happen is we'll see new systems, new registries, new methods that will come in that will help to just do a better job of increasing confidence and keeping up with new methodologies. I think that's really exciting. And then the third thing I would say is this is growing, it's getting bigger. And I think as we move toward more standardization, we're going to see it become more of a really interesting financial market. And I think that will be very, very cool to see.
Okay, we have time for one more question.
Yeah, so that actually just answered the question from Will Johnson about how does the registry evolve as a VCM scales. Last question is from Corinne Neal as well. You mentioned the reversal in relation to permanence. What is it and how do you handle
it? What is reversal?
Reversal in relation to permanence.
Permanence? Okay.
Yeah. So, what is it and how do you handle it?
Yeah. So a reversal is like, think about a great example of a reversal is we had a carbon capture and utilization project that took emissions from a coal plant and it stored those emissions in a shale formation underground. But then there was an earthquake and all of the CO2 was released to the atmosphere, right? So that's a reversal.
Oh.
Or we stored a bunch of carbon in a forest and then it burned down. That's a reversal. So those are examples. And permanence is like how permanent, what is the reversal risk, right? Like how permanent is the storage? How likely is it to be lost to the atmosphere once it's been stored?
Excellent. Thank you, Jen.
Okay. Well, thank you all so much for being here today. Howard is going to wrap it up with a few last questions, but Jen, we absolutely loved this conversation with you. You have so much to say. I know we could keep this going for a couple more hours.
Thank you.
And thank you again.
Yeah, thank you. It's been a pleasure.
I was confused. I just like to say the DASV thanks Dr. Jenkins for her presentation today and our participants for attending and submitting thoughtful questions. Please watch our website and newsletters for future sessions in this series and enjoy the rest of your day. Thank you very much.